Welcome to the Deep Dive, everyone. We're brought to you by Market Insight Cast. If you're looking for that shortcut to being, truly well-informed, you've definitely landed in the right place. We're here to cut through all the noise, take that stack of your articles, your research, maybe even your own notes, and really pull out those golden nuggets of knowledge that truly matter. You can also find us over on YouTube at Market Insight Cast. We try to bring these deep dives to life visually over there, too. Check it out. So today we are embarking on what I think is going to be an absolutely fascinating deep dive. We're looking at UnitedHealth Group, ticker symbol UNH. And this isn't just, any company. It's truly one of the absolute titans of the entire healthcare industry, a real behemoth.
It really is. And, with their Q2 2025 earnings release just around the corner, it's scheduled for July 29th, right before the market opens. Well, now is the perfect, I'd say, opportune time to peel back the layers, really try and understand what's actually happening under the hood of this colossal organization. Because its size, well, it means its movements ripple across the entire sector, doesn't it?
That's precisely it. UNH isn't just a company. It's really a bellwether for the whole healthcare sector. Its performance, its challenges, they can tell us a tremendous amount about the broader market dynamics that you, our curious listener, absolutely need to know. We've meticulously gathered all your notes, all your research, every insightful article you've shared with us. We're going to unpack everything, from its foundational core business right through to its recent financial roller coaster, and it has been a roller coaster, and then, crucially, peer into what might lie ahead. And today, we're going to approach this from two, let's say, distinct yet complementary perspectives. We'll shine a light on the opportunities that, seem to sparkle for UnitedHealth Group. And my colleague here will be examining the challenges that undeniably cast a shadow. It's important to see both sides.
That's right. Need that balance.
Exactly.
Yeah.
So, are you ready? Let's dive in. Okay, let's really set the stage first. Let's try and grapple with the sheer undeniable scale of UnitedHealth Group. It's just massive. When you look at UNH, you're not just looking at a national player. No, you're looking at a global leader. They operate extensively across the U.S., of course, but also internationally. And their mission statement itself, it's incredibly ambitious. It really speaks to their overarching purpose, helping people live healthier lives and helping the health system work better for everyone. I mean, that right there, that's an undertaking of colossal proportions, isn't it?
It absolutely is. A huge goal.
And when we talk about scale, we mean it in every sense of the word. This isn't, some small to medium enterprise. As of 2024, UNH employs approximately 400,000 full-time employees. Just pause for a moment and think about that number, 400,000 people. That's a workforce roughly the size of a major city. It makes them an absolutely massive employer. It's a significant contributor to the economy. And when it comes to revenue, wow, we're talking colossal figures. Over $400 billion in 2024. That's $400 billion. That's not just large. That revenue figure firmly plants them as a truly dominant player, not just in the U.S., but really globally. They make huge waves across the world.
You've rightly highlighted their immense scale, host. But what's crucial here, I think, is to recognize that while UNH's market position is indeed dominant, it's a truly staggering achievement being the largest healthcare company by revenue in 2024. Such dominance inherently invites, intense scrutiny and critically significant regulatory risk. It's not simply about being big, right? It's about the profound implications of that size in an industry as vital and, frankly, as heavily regulated as healthcare. Regulators, competitors, the public, they all watch a company of this magnitude with an exceptionally critical eye. You're under a microscope.
Exactly.
You really are. And this colossal entity, it's structured in a remarkably smart way, I think, dividing its operations into two main, incredibly complementary business segments. This dual-pillar approach is absolutely key to its comprehensive strategy in healthcare. It allows them to cover so much ground. First, there's UnitedHealthcare. Now, this is their core health insurance and benefits arm. This segment is all about providing coverage and services directly to millions and millions of people. It's probably the part most folks are familiar with. And within UnitedHealthcare, you find several critical subsegments. There's the employer individual segment. This serves, employer-sponsored health benefits and also offers individual and family plans. This covers just a vast spectrum of the workforce and private citizens. It demonstrates their reach into pretty much every corner of the employed population. Then you have Medicare and retirement. This is specifically tailored for individuals aged 50 and above, a huge demographic. And this is where they offer a whole suite of services. Medicare Advantage, which we'll talk a lot about, Medicare Part D for prescription drugs, Medicare supplement plans or Medigap, and even group retirement services. This is a truly massive and incredibly important market segment. Just to give you a sense, it was serving approximately 50.1 million individuals way back in 2015.
That clearly highlights their deep, deep penetration of the senior care market, a demographic with specific and often quite complex healthcare needs.
Very complex.
And finally, within UnitedHealthcare, there's the community and state segment. This one is dedicated to reaching some of the most vulnerable populations. This arm provides diverse healthcare benefits and services to around 7.5 million people who are economically disadvantaged or medically underserved. Think Medicaid managed care, programs like that. This commitment really demonstrates their incredibly broad scope, serving a wide range of populations from, employees at Fortune 500 companies right down to the most vulnerable individuals in society.
Okay, and if we connect this segmentation and scale back to the broader market, quantifying their grip, well, it reveals just how concentrated this industry has actually become. And that concentration, it's both a strategic advantage for UNH, obviously, but also a potential liability, as I mentioned. They held over 15.3% of the entire U.S. health insurance market back in 2021, which is already pretty big. But get this, by Q1 2025, their market share in the accident and health insurance industry had surged to an astounding 33.52%.
Wow.
Yeah, think about that. More than a third of the market. That's a truly massive slice of the pie. Huge. And the concentration becomes even starker when you look at the Medicare Advantage market, the MA market, which, as you noted, is a key growth area for them. It's strategically vital. UNH is the largest operator in MA, covering 29% of all MA enrollees in 2024, nearly 3 out of 10. But here's where it gets truly significant, I think. When you combine their share with Humana's, another big player, they collectively control nearly half. A staggering 47% of all national MA enrollees.
Almost half the market between two companies.
Exactly. And that level of market concentration, well, it raises profound questions, doesn't it? Questions about competition, about consumer choice. Does such dominance ultimately serve the public interest by driving efficiency, maybe lowering costs? Or does it create the potential for market power abuses that could stifle innovation, or worse, limit consumer options and drive up prices? It's a real debate. And they're also the largest insurer by market share in the U.S. commercial health insurance market, the employer side you mentioned. So leading the industry in premium revenue of approximately $249 billion in 2023, it absolutely underscores their immense financial might, no question. However, this financial prowess also comes with the immense responsibility and the inherent risks of managing a sheer volume of claims and medical costs, billions and billions in claims. And that can quickly become a double-edged sword when those costs fluctuate unexpectedly, which, spoiler alert, is exactly what we've been seeing recently.
Right. And on the other side of that strategic divide, you have Optum. Now, this segment is often referred to as their innovation and service engine. And it's truly leveraging technology and data to deliver healthcare services and tools in incredibly forward-thinking ways. It's really the future-focused part of the business, always innovating, trying to improve health for people, for their partners, and for healthcare providers themselves. It's about making the system work better, like their mission says. Within Optum, you have 3 distinct but interconnected pillars. First, Optum Health. This is their patient-centered care delivery arm. It focuses on providing high-quality, value-based healthcare across communities nationwide. And just to quickly clarify for folks who might not be familiar, value-based care basically means they get paid based on patient outcomes and the quality of care provided, rather than just the sheer volume of services like, fee-for-service.
Right. It incentivizes better care, theoretically. Exactly. It incentivizes better, more efficient care. So Optum Health is about direct patient care, but with this tech-driven, outcome-focused approach. They own clinics, employ doctors, etc. Then there's Optum Insight. This is where the data and the software truly come into play. Optum Insight is designed to simplify and improve clinical, administrative, and financial processes for the entire healthcare system. They partner with payers, other insurance companies, providers, government entities, life science companies, basically everyone. They work to advance value-based care by optimizing the whole ecosystem through data analytics and technology. Think big data for health. And finally, Optum Rx. This is their pharmacy benefit management service, or PBM. Optum Rx helps people access safe and effective prescription drugs and therapies, ideally at more affordable costs than those imposed directly by manufacturers. This PDM component is absolutely crucial in managing overall healthcare costs, both for patients and for the system itself. It acts as a significant lever for efficiency within the broader system. It's complex, sometimes controversial, but a vital part of their operation. Host, you've meticulously laid out their immense scale and their, frankly, incredibly smart complementary segmentation. It's impressive structurally. But this raises a critical question, doesn't it? How does UNH's immense scale and the strategic segmentation actually translate when you compare it with its major competitors, particularly in terms of profitability? Size isn't everything if the margins aren't there. So let's zoom in a bit. How does UNH stack up against its major rivals like, say, the Cigna Group, Elevance Health, Humana, Centene, and CVS Health, which owns Aetna? The financial indicators from Q4 2023 reveal some very interesting and perhaps concerning trends that go beyond just market dominance. While UNH is indeed a behemoth, as we've established, its net income margin actually decreased by 0.6% from Q3 to Q4 2023. It landed with a medical loss ratio, or MLR, of 85.0%. And just to remind folks that MLR is the percentage of premium revenue that an insurer spends on medical claims and quality improvements. So 85% went out the door for care.
Right, so a higher MLR means less money kept by the insurer.
It's exactly less profit margin on the insurance side. Now, in stark contrast, Cigna Group, while smaller, saw a significant 4.1% increase in net income margin during that same period. Now, it's important to note this was partly due to some deferred tax benefits, so maybe not purely operational, but critically, Cigna maintained a lower MLR of 82.2%, so they kept more of each premium dollar. Elevance Health and CVS Health, including Aetna, they also experienced decreases in net income margins similar to UNH, with even higher MLRs, 89.2% and 88.5% respectively. And Humana and Centene, using similar metrics, had even higher ratios, still 91.5% and 89.5%. So very high payout ratios there. What this data from late 2023 clearly indicates, I think, is a general trend where increased medical costs were impacting profitability across the board for pretty much all the major healthcare insurers. It wasn't just a UNH problem, but UNH, despite its size and its comprehensive structure, was certainly not immune, and in fact their MLR at 85% was not the lowest among that group, which directly suggests that cost management remains a perpetual and significant challenge even for the undisputed market leader. It's a fundamental pressure point that can really erode even the most robust top-line growth if it gets out of hand.
Okay. That's a really important context looking back at late 23. Let's now shift our focus squarely to the rearview mirror of this year and highlight the undeniable resilience and growth that UnitedHealth Group demonstrated amidst those challenges, specifically in Q1 2025. Because when you zoom out and look at the big picture for Q1 2025, UnitedHealth Group truly showed some impressive growth across the board, really strong numbers. Total revenue hit nearly $110 billion, specifically $109.575 billion. That's a healthy 9.8% increase year over year from about $99.8 billion in Q1 2024. This figure alone clearly shows consistent, robust demand for their wide array of services. People still need and are buying their products. Operating income wasn't far behind. It rose by 15.4% to $9.119 billion, up from $7.9 billion. This indicates their strong ability to generate profits from their core operations, which is always a positive sign for any company, right?
Core profitability is key.
And net income, solid. A 13.5% increase, reaching $6.292 billion compared to $5.543 billion in the prior year quarter. Earnings per share, or EPS, significantly improved to approximately $6.85. That represents a substantial 23.7% jump from about $5.54 in Q1 24. So good growth there. Now here's the crucial context that really amplifies these numbers, and it's something listeners need to remember. Q1 2024 was heavily impacted by costs related to that massive cyber attack on Change Healthcare, which they own through Optum. That attack actually led to a net loss that quarter. So the recovery to such a strong net income and a healthy margin of 5.7% in Q1 2025, especially when compared to a negative 1.4% margin in Q1 2024, what truly showcases the company's operational recovery and its underlying profitability in a very compelling way. It's really a testament to their ability to bounce back from significant external shocks.
Host, you're absolutely right to highlight the recovery aspect and the strong top-line growth. That cyber attack was a major event, no doubt. But what's truly fascinating here, and I think perhaps more concerning when you dig deeper, is the nuance behind those impressive top-line numbers, specifically regarding rising costs and those shifting margins we talked about. While the revenue growth is indeed undeniable, you really need to look beyond that headline figure. The devil, as they say, is always in the details, isn't it? Particularly when it comes to profitability and those persistent cost pressures. Despite the increased revenue you mentioned, the medical loss ratio, the MLR, actually increased again to 84.8% in Q1 2025. That's up from 84.3% in Q1 2024.
Okay, so it ticked up again.
It ticked up again, and this seemingly small 0.5 percentage point increase, it's actually incredibly significant in the razor-thin margin world of the insurance business. Every 0.1% matters hugely. Think of it like a restaurant with booming sales, right? Yeah. But their food costs are just creeping up steadily. The more they sell, the less profit they actually keep per dish. This MLR increase signals rising medical costs relative to the premiums they're collecting. And the trend seems to be driven by a few factors: Medicare funding cuts, maybe some shifts in member composition within their plans, but perhaps most crucially, unexpectedly higher medical activity, higher utilization among seniors, especially in their Medicare Advantage plans. And this directly impacts their profit margins. It reduces the amount of premium dollars they retain, making cost management a continuous uphill battle, even with rising revenue.
Okay, that MLR point is definitely something to watch. But let's break down the segments in Q1 because there was strength there too. UnitedHealthcare, their insurance powerhouse, brought in $84.617 billion in revenue. That's an increase of about $9.3 billion year over year, which is a substantial jump by any measure. Its operating income grew by $8 billion to $5.2 billion, pushing its operating margin up slightly to a healthy 6.2% from 5.8%. So margin expansion there. The growth drivers here are particularly interesting, I think, and they paint a picture of strategic expansion. They added around 700,000 self-funded commercial benefits customers. That shows strong corporate client acquisition, which speaks volumes about their value proposition for employers, right? Businesses are choosing them.
Good sign on the commercial side.
And critically, they saw an increase of 545,000 customers in the senior and complex health categories that's mostly Medicare Advantage. And they had an expectation to add up to 800,000 for the full year 2025 in that category. This really points to successful expansion in these high-value demographics that, yes, often require more comprehensive and sometimes more expensive care, but also represent significant long-term opportunities for the business. Their community and state health insurance membership also expanded to 7.6 million people, growing relationships in key states like Kentucky, New York, and Florida. So this consistent membership growth across such diverse segments really highlights the strength and breadth of their health insurance arm's market reach and its ability to attract new members. People are signing up.
Post, you've outlined strong growth in UnitedHealthcare, particularly in membership numbers across the board. That's clear. But, and this is a big but, even within that seemingly strong segment, there's a significant underlying burden. You hinted at it. The higher medical service activity, that higher utilization, particularly in the Medicare Advantage segment, despite the overall growth in enrollees, it acted as a very significant drag on operating income for UnitedHealthcare in Q1. This is a critical area of concern. Why? Because Medicare Advantage is precisely where UNH is the dominant player, as we discussed, and it's strategically positioned as a key growth engine for the whole company. But if rising costs in this specific crucial segment can severely eat into profits like this, well, it calls into question the long-term sustainability and the quality of that growth. Is it profitable growth? It's like having a highly anticipated new product line that sells incredibly well, but it costs way more to produce than initially expected, just cutting into your overall margin significantly. It dampens the success story. And then looking over at Optum, which, as you've pointed out, is often hailed as their future-forward growth engine, the innovation hub. Well, there are areas of concern there, too, in Q1. Optum Health specifically, the part that owns clinics and employs doctors, it had its growth rate limited in Q1. And this wasn't due to a lack of demand, apparently. It was rather due to adjustments in existing customer contracts and shifts in member profiles within those contracts. So despite an overall increase in the number of patients they serve, these internal factors prevented Optum Health from fully capitalizing on that growth, which, raises questions about its consistent profitability contribution and whether it can truly carry the weight of being the primary reliable growth driver moving forward. The promise is definitely there, but the Q1 execution showed some friction.
Okay, fair points on the constraints there. But despite some of those growth limitations, specifically in Optum Health, let's talk about the Optum segment as a whole, because it was still robust. This segment contributed a strong $63.9 billion in revenue. That's up $2.8 billion year over year. Its operating income was $3.9 billion, a $2.4 billion increase. And that led to an improved operating margin for Optum overall, up to 6.1% from 5.8%. So profitability improving for the segment as a whole. And when we dive into the subsegments within Optum, you really do see true innovation in action. This is where things get exciting, I think. Optum Insight's revenue was $4.6 billion. Now, what's truly exciting here, and something you actually pointed out in your notes, is the launch of these AI-based claims processing tools. These are expected to boost productivity by over 20%. Think about that, 20%.
That's a huge efficiency gain if it pans out.
Exactly. This is where technology truly translates into tangible efficiency. Streamlining operations, reducing those massive administrative burdens across the entire healthcare system, and potentially saving billions in the long run. It really feels like a game changer for administrative costs.
Yeah.
Then there's Optum Rx, the PBM, with $35.1 billion in revenue. This segment saw growth through new customer acquisitions and expanded relationships with existing ones. That demonstrates their ability to attract and retain clients in the very competitive pharmacy benefit management space. They're winning business. Now, while the source notes mention a 3% prescription increase and the actual numbers provided in the source material show a slight decrease in raw prescription volume from 408 million scripts down to 395 million, the overall growth in revenue for Optum indicates that they're finding ways to grow their business value.
Right, so maybe higher value drugs or better rebates.
Could be. Higher value prescriptions, more effective cost management on the PBM side, perhaps shifts in the drug mix towards more profitable therapies. Something is driving that revenue up. Ultimately, they're driving greater profitability per prescription, perhaps, even if the raw volume had that minor fluctuation. This speaks to their ability to optimize revenue generation within the really complex PBM space.
Okay, host, you've highlighted the internal dynamics, the segment performances, the nuances within Optum. But the most immediate and frankly painful consequence of these underlying issues beyond just the internal numbers on a spreadsheet was the dramatic and almost instantaneous reaction from the stock market. This served as a real wake-up call for investors, I think, and a stark reminder of how quickly sentiment can shift when doubts creep in. On April 17, 2025, immediately after that Q1 earnings release, UNH's stock just plummeted. It fell by approximately 19%. 19% in a day.
Huge drop.
Massive. It fell from nearly $585 down to around $473. This is not a minor correction. It's a significant, undeniable vote of no confidence from the market, wiping billions and billions off their valuation almost overnight. Now, a key trigger for this sharp decline was the reported EPS of $7.20, which, while up significantly year over year due to the cyberattack comparison, narrowly missed analysts' expectations. They were looking for $7.29.
Just short.
Just short. But even a slight miss like that, especially when it's combined with these broader concerns about rising costs and the specific issues bubbling up in Medicare Advantage, well, it can have really outsized effects on market sentiment. But the market's reaction wasn't just about that slight EPS miss, though. It was fundamentally driven by the escalating Medicare Advantage costs. There was a palpable fear that these higher-than-expected medical service costs would persist, that they weren't a one-off, and that they would continue to erode future profitability. There was also significant uncertainty surrounding Optum Health. Those unexpected changes in member profiles, maybe even some market exits that were hinted at within the supposedly stable growth driver segment, well, that raised significant concerns among investors about its reliability and its long-term trajectory. So it's kind of a double whammy, right? The core insurance business facing cost pressures and the designated growth engine, Optum, showing unexpected jitters. Not a good combination.
Right, but alongside those pressures, let's not lose sight of the efficiency improvements we saw across the board in Q1. The overall operating cost ratio actually improved. It went down to 12.4% from 14.1% the year before. That's a significant improvement in efficiency. And this was largely driven by changes in Medicare Part D programs, which helped streamline operations, and crucially, more efficient technology investments across the entire company, like that AI and Optum Insight. This shows incredibly effective cost management on the administrative side, I think. It's a testament to their operational discipline and their ongoing commitment to leveraging technology for efficiency gains. They are tightening the belt where they can. And let's not forget, the company returned approximately $5 billion to shareholders through dividends and share repurchases in Q1 alone. $5 billion. This is a strong signal of confidence, isn't it? Confidence in their financial health and their unwavering commitment to providing value back to their investors, even amidst a challenging environment.
Returning cash is usually seen positively.
It indicates a stable company that is still generating substantial cash flow. Despite all the headlines and the stock drop, that cash has to come from somewhere.
True, but furthermore, adding to those financial concerns and really amplifying the market's negative reaction were significant external headwinds. Things outside their direct control, maybe. There was the sudden resignation of the CEO. That always creates leadership uncertainty, doesn't it? Raises questions about internal stability, strategic direction. Then, a federal government investigation by the Department of Justice into their Medicare claims practices. This is serious. A DOJ investigation is not something you brush off. It's a major legal and regulatory overhang that could lead to substantial fines or mandated operational changes.
Yeah, that's definitely a shadow.
And let's not forget the lingering financial impact and, just as importantly, the reputational uncertainty from that Change Healthcare cyberattack that happened back in Q1 2024. These things have long tails. These non-financial risks, they amplify investor anxiety. They create this complex web of challenges that go beyond mere operational adjustments or cost controls. But perhaps the most telling indicator, the starkest reality check, however, is the bleak year-to-date performance of the stock. As of July 25, 2025, the stock was trading way down at about 281 guns. That represents a staggering 44% decline year to date. 44%.
Wow, nearly cut in half from the start of the year.
Pretty much. This is a massive underperformance compared to the broader market, the S&P 500, and a significant fall from its all-time high of nearly $616 recorded just back in November 2024. This extended and dramatic decline indicates that the market views these issues not as just short-term hiccups, a bad quarter or two, but as potentially more entrenched systemic challenges that will require significant effort and probably significant time to resolve. It's not just a bad quarter, it's a sustained loss of market confidence that has wiped out hundreds of billions in value.
Okay, a very tough period for the stock, undeniably. Let's pivot now from that rearview mirror and peer into the future. Let's anticipate what Q2 2025 might hold with earnings coming up very soon. Because even amidst all this noise and the recent volatility we've just discussed in painful detail, you'll find that analysts are still projecting significant revenue growth for UNH in Q2 2025. This is where we start spotting potential opportunities again. Forecasts for Q2 revenue, they range from about $111.5 billion up to nearly $112 billion. Let's call it $111.5 to $111.9 billion. This represents a robust increase of somewhere between 12.8% and 13% year over year. That's strong top-line growth continuing. This indicates that the core demand for UNH's healthcare services and insurance products remains incredibly strong and persistent. That's a fundamental positive for the business, isn't it? It shows that despite the headlines, the underlying need for what they provide isn't going anywhere. People still need health insurance and healthcare services. So the narrative here, if you look beyond the immediate turbulence, the narrative you could build is one of recovery and long-term value.
While the EPS, the earnings per share, might indeed see a temporary dip in Q2, and we'll get to that, and you have to remember the long-term potential here. Analyst firms like Bernstein, for example, they view the current stock price as undervalued. That's their assessment. They anticipate a strong long-term recovery and significant profitability improvements down the road. They're even projecting an impressive 19% annual EPS growth rate through 2029, 19% CAGR.
That's a very bullish forecast given current trends.
It is bullish, yes.
Yeah.
But it comes with a clear buy recommendation from them. This really suggests that for a discerning long-term investor, someone willing to look past the next quarter or two, the current dip could be an attractive entry point. It's essentially betting on the company's inherent ability to navigate these current challenges, which they've done before, and the robust foundational business it operates. It's about seeing the forest, perhaps, through the very noisy trees right now.
Hosts, while those optimistic revenue projections are indeed on the table, and Bernstein's long-term view is certainly noted, you simply cannot, absolutely cannot, ignore the glaring red flag in the Q2 2025 earnings forecast. And that is the projected EPS decline. The bottom line, analysts are predicting an EPS of just over $4.80 to just under $5. The range seems to be $4.84 to $4.94. This represents a staggering 27.4% to 28.8% decrease year over year. Let that sink in, down almost 30% on the bottom line.
That's a big drop from Q2 last year.
It's huge. This is not a minor hiccup. It is a significant hit to their earnings power. And moreover, EPS estimates have been lowered by 6.6% in just the last month alone. That indicates growing pessimism among the analyst community, which is a crucial detail to note from your sources. They're becoming less optimistic as the quarter progressed. This strongly suggests that the cost pressures we discussed, particularly in Medicare Advantage, are not abating, they're real, they're persistent, and they are directly impacting the bottom line despite that continued top-line revenue growth. It really raises the critical question of whether revenue growth alone is enough if profitability is eroding so significantly. It's like owning that rapidly growing chain of stores we talked about, but each new store you open is actually less profitable than the last one. That's not a sustainable model.
Okay, the EPS forecast is definitely a challenge. Now let's talk about the guidance adjustments, because that caused a stir too. The company's decision to first lower and then completely withdraw its full year 2025 adjusted EPS guidance. Well, it was indeed a signal of increased cost pressures, particularly for Medicare Advantage. That's undeniable. They originally guided for around $27.66 for the year. Then, after Q1, they lowered it to a range of $26 to $26.50. And then on May 13th, they withdrew it entirely, pulled it. Now, one way to interpret this, perhaps the more charitable way, is that the company is being transparent.
They're proactively managing expectations in a volatile environment. And in the long run, you could argue, this kind of transparency can actually build crucial trust with the market once these issues are thoroughly resolved. It's about setting realistic expectations. Even if those expectations are challenging in the short term, perhaps it's a bitter pill now for a healthier relationship with investors later.
Transparency is one thing, host, and maybe that's part of it. But what's truly troubling, I think, is the very act of that guidance withdrawal itself, particularly after already lowering it just weeks before. The withdrawal of the full year 2025 guidance on May 13th, that's a deeply concerning signal. Why? Because companies typically only withdraw guidance when they have very low confidence in their own ability to meet previous projections. Or, alternatively, when the future is simply too uncertain, too murky to forecast with any kind of precision. This lack of clear visibility into their own future earnings power, that is a major red flag for investors. It means the company itself, the people running it, don't have a clear line of sight on their own earnings trajectory for the rest of the year.
Lack of visibility is definitely not what investors like to see.
Exactly. And this is especially alarming when the primary reason they cited was the unexpectedly higher medical service activity in Medicare Advantage. This suggests the issue is fundamental. It's potentially very hard to control, rooted in the core operations of their most critical and historically most profitable segment. And market's expectation of further profitability decline in UnitedHealthcare for Q2, that projected EPS drop we just discussed, well, it aligns perfectly with this withdrawn guidance. It reinforces the idea that these are likely systemic problems, not just isolated incidents that can be easily fixed in a quarter or two.
Okay, so a lot of uncertainty swirling around Q2. So as you, the listener, prepare for that Q2 earnings call, let's highlight some specific indicators you should keep a keen eye out for, things that could signal positive movement, the potential green shoots we're looking for. First, watch the Medicare Advantage cost trends. This is paramount. Look for any signs, any commentary, suggesting that the medical cost increases in this segment are stabilizing or perhaps even moderating. Even small improvements here could have a significant positive impact on profitability and, importantly, on investor sentiment, as it's currently the biggest headache, right?
Absolutely the biggest focus.
Next, closely observe Optum Health performance. Is that growth limitation we discussed the one due to existing contract adjustments and member profile changes? Is that starting to ease up? Optum's robust performance, particularly Optum Health, is absolutely crucial for UNH's long-term growth story. It represents their big push into those innovative, value-based care models, which is supposed to be the future of healthcare. We need to see that engine firing. Another key metric is the medical loss ratio, MLR, overall. Watch if the MLR, which ticked up to 84.8% in Q1, shows signs of stabilization or, even better, a slight decrease in Q2. This would be a strong indicator of improved cost management and potentially a return to healthier profitability. A downward trend here, even a small one, would be incredibly reassuring to the market. Furthermore, keep an eye on how they are navigating external risks. While those investigations and leadership changes are unsettling, look for any clarity from the company on their plans. How are they addressing the Department of Justice investigation into Medicare claims practices? What's the latest on the aftermath of the cyberattack? Any clear communication, any signs of decisive action, or perhaps resolution efforts on these fronts would be a significant positive for investor sentiment. It would help remove some of that overhanging uncertainty that has clearly plagued the stock. And finally, of course, consider the stock reaction and analyst revisions after the earnings are released. A positive surprise in the Q2 report, or even just meeting the lowered expectations without any new negative surprises, could potentially lead to a swift rebound in the stock price. Why? Because the market is likely highly sensitive to any good news after such a steep decline. Keep a close eye on how analysts adjust their ratings and price targets post-earnings. That will give you a sense of renewed institutional confidence, or lack thereof, and signal a potential turning point.
Okay, host, that's the optimistic watch list. But on the flip side, as you consider the Q2 earnings, these are the critical, unresolved issues that should unequivocally give you pause and demand very close scrutiny. These are the potential landmines. The persistent Medicare Advantage cost increases remain the absolute paramount concern. Is the trend of higher medical costs in the MA segment truly persistent? Is it the new normal? If so, it will continue to erode profitability significantly quarter after quarter. This is the core reason they cited for the guidance withdrawal, remember. And if it continues, it poses a fundamental challenge to their most profitable and largest segment. It's like a foundational crack in what should be their strongest pillar. It needs fixing, fast. Next, keep a close watch on that potential stagnation in Optum Health. While Optum as a whole shows growth, those specific constraints on Optum Health's growth due to existing client contract adjustments and member profile changes, they need to be monitored very closely. If this segment, which is supposed to be a key long-term growth driver and the innovative edge of their business, continues to underperform relative to expectations, well, it raises serious questions about the overall strategic direction and execution within Optum. It impacts the broader growth narrative and investor confidence in their future prospects. The unstable medical loss ratio, MLR, is also critical from the negative perspective. The MLR of 84.8% in Q1 was a slight increase. Will it continue its upward trajectory in Q2? An increasing MLR directly translates to less money retained by the insurer for every premium dollar collected. It signals worsening profitability. This metric is a vital health check for the core insurance business, and a continuous upward trend would be deeply, deeply concerning. It would indicate a potential loss of cost control. And you must absolutely consider the cascading external risks. These haven't gone away. The ongoing federal government investigation by the Department of Justice into Medicare claims practices is a serious legal and regulatory overhang. This isn't just some minor inquiry. It could lead to substantial fines, significant operational disruptions, maybe even mandatory changes to their business practices that could fundamentally alter how they operate and compete. Couple that with the unexpected CEO resignation earlier, which creates leadership uncertainty at a really critical time, and the lingering financial and reputational fallout from the cyber attack. These factors collectively create a profound cloud of uncertainty. These aren't just bumps, they are ongoing liabilities that can severely impact investor sentiment and financial performance for the foreseeable future, regardless of the core business operations. They are unpredictable and potentially very costly. And finally, we need to talk about stock volatility and valuation concerns from the skeptical side. The stock's dramatic 44% year-to-date decline in 2025, significantly underperforming the S&P 500, it speaks volumes, doesn't it? It reflects market sentiment and genuine investor fear. While some institutions like Bernstein may call it undervalued, remember, a stock drops that much for a reason, usually multiple reasons. Investors must critically assess whether that projected 19% EPS AGR through 2029 is actually realistic, given the current, very real earnings pressure and all these unresolved issues. The short-term stock weakness is likely to persist until there is concrete, unambiguous evidence of problem resolution and a clear path forward. This could very much be a classic bear trap for those who jump in too soon, thinking the bottom is definitely in without sufficient evidence of a real turnaround. Buyer beware, essentially.
Okay, here's where it gets really interesting, folks. This leads us directly to the big debate, the question that's dominating investor conversations right now. Is UNH currently a compelling buy? Does it present an incredible long-term opportunity after this significant dip? Or is it a deceptive bear trap, potentially destined for further struggles and maybe a prolonged period of underperformance? Let's hash it out. Let me start with the argument for optimism, the buy case, if you will. When you zoom out, when you look at the foundation of strength for UnitedHealth Group, you truly see an absolute powerhouse. No question. Its market dominance is basically unrivaled. It makes it an indispensable, almost irreplaceable part of the American healthcare system. They touch so many lives, so many parts of the system. They serve literally millions upon millions of people across incredibly diverse segments, employer-sponsored plans, individual plans, Medicare beneficiaries, those vulnerable communities through community and state programs. This isn't some speculative startup with an unproven business model, right? It's a deeply entrenched, essential service provider whose business model is fundamental to how healthcare operates in the U.S. Think about the sheer scale and the absolute necessity of their operations. Their services are not really optional for the economy or for individuals. This inherent demand provides a powerful stabilizing force, making its top-line revenue almost recession-proof in many ways. Then there's Optum. Okay, while Optum Health might have hit that temporary snag we discussed, the Optum division as a whole is nothing short of a marvel, I think. Optum Insight, for example, isn't just talking about innovation. It's actively leveraging AI to revolutionize claims processing, promising those 20% plus productivity gains. This isn't just about cutting costs for UNH internally, it's about leading the entire industry into a more efficient, technologically advanced future for healthcare delivery and administration. That has value beyond just UNH. Optum is clearly positioned as the future of healthcare, driving value-based care, advanced analytics, and UNH owns this massive piece of that future. This strategic advantage, focused on technology and data, fundamentally differentiates them from many traditional insurers. It gives them a long-term competitive edge that should, theoretically, transcend current operational challenges. Yes, there are temporary headwinds, absolutely. Medicare Advantage costs are a current pressure point, no doubt. The cyber attack was a significant event. But these are fundamentally operational challenges, aren't they? Not a fundamental flaw in the business model itself. UnitedHealth Group has demonstrated its ability to adapt, to optimize its operations over decades of experience. We've already seen a remarkable recovery from the Q1 2024 cyberattack costs, which severely impacted that quarter. That recovery alone shows their incredible resilience and capacity to overcome significant obstacles. These are simply bumps in the road, perhaps larger than usual bumps, yes, but they're not a permanent breakdown of their core business. They have the expertise, the resources, the sheer scale to navigate this turbulent period and come out stronger. And this brings us to what looks like a significant valuation opportunity. When a stock falls 44% year-to-date, especially for a company with such robust fundamentals, such deep market penetration, providing such essential services, well, it presents a rare opportunity for discerning long-term investors. Institutions like Bernstein aren't just speculating wildly, they see the underlying value. They see the potential for that compelling 19% EPS compound annual growth rate through 2029. This means significant growth is still expected once these current issues are worked through and resolved. It's an investment in the long-term trajectory of a market leader. This isn't a bear trap, in my view. It's a chance to buy a market leader at a significant discount, riding out the short-term noise for what could be substantial long-term gains. It's betting on their proven track record of innovation and adaptation over time. And finally, let's not forget their unwavering commitment to shareholders. The company returned approximately $5 billion to shareholders through dividends and share repurchases in Q1 alone. $5 billion. That speaks volumes about management's confidence in their own financial health and their ability to generate substantial cash flow, even despite the recent headlines and short-term challenges.
Okay, returning cash is good.
It indicates a stable company that is still actively generating and returning value to its investors. That's a powerful sign of financial robustness and confidence from within the company itself. They're putting their money where their mouth is, so to speak.
Host, you've painted a compelling picture of resilience and long-term potential, and I certainly don't dispute the underlying scale and the fundamental importance of UNH in the healthcare landscape. That's undeniable. However, you simply cannot ignore the depth of the earnings problem right now. While top-line revenue growth is certainly a positive talking point, and it reflects the sheer demand for their services, that projected 27–28% decline in Q2 EPS, following a Q1 that already disappointed on the bottom line relative to expectations, well, it represents a significant and undeniable deterioration of profitability. This isn't just a temporary blip when the company takes the drastic step of withdrawing its full-year guidance. That's a profound red flag. It indicates fundamental uncertainty about their ability to manage costs, specifically, as we've hammered home, in their critical Medicare Advantage segment. It suggests that the revenue growth isn't translating to the bottom line as effectively as it should be or as it has in the past. It raises serious concerns about operational efficiency and cost control that feel more systemic than fleeting right now. The reality is, those persistent cost pressures are very real, and they appear to be eating into their core business profitability. The increase in the medical loss ratio in Q1, driven by that higher medical service activity among seniors, clearly shows that the core insurance business is facing real, tangible cost pressures. This isn't just a one-off event from a bad flu season, perhaps. It speaks to the systemic challenges of managing an aging population's healthcare needs, and maybe the financial sustainability of Medicare Advantage programs under the current regulatory and reimbursement structures. If these costs continue to rise, or even just stay elevated, it will fundamentally erode margins across their most important insurance products. It will make it very difficult for them to regain prior profitability levels without significant changes, maybe price increases or benefit reductions. The MLR is a direct measure of their ability to manage these costs effectively, and its upward movement indicates a serious challenge in their core operations. And while Optum is indeed key for the future and holds great promise on paper, the fact that Optum Health's growth was specifically limited in Q1 due to existing contract adjustments and member profile changes, that is deeply concerning. This isn't just a minor blip for some experimental division. This suggests that even their much-touted growth engine, the part of the business that's supposed to propel them forward with innovation, isn't immune to operational headwinds or perhaps execution issues. If the most innovative and forward-looking part of their business isn't firing on all cylinders and hitting its growth targets, well, it puts even more pressure back on the already struggling traditional insurance arm to carry the load. This raises critical questions about the consistency of their growth drivers and the immediate impact, or lack thereof, of their long-term strategic investments. Furthermore, you cannot simply dismiss the significant web of external risks hanging over UNH. These are real threats. The legal and regulatory clouds are not to be dismissed lightly. That Department of Justice investigation into Medicare claims practices is incredibly serious. It could lead to substantial fines, operational disruptions, mandatory changes to their business practices that could fundamentally alter how they operate, how they get paid. Couple that with the unexpected CEO resignation earlier this year, which creates leadership uncertainty at a crucial juncture, and the ongoing fallout from the cyber attack, which still has lingering financial and reputational impacts. These factors collectively create a palpable sense of pervasive uncertainty. These aren't just bumps in the road. They are ongoing liabilities that can severely impact investor sentiment and financial performance for the foreseeable future, regardless of their core business operations. They add a layer of unpredictable risk that can definitely outweigh even strong fundamentals in the short to medium term. Therefore, calling a stock undervalued after a 44% year-to-date decline might be tempting, right? And it's easy to look at the historical strength and assume a quick bounce back. But it requires a very careful and critical assessment right now. The market has already factored in significant concerns, and arguably for good reason based on the guidance withdrawal and the EPS trends. The crucial question isn't just where the stock could be in 5 years, but whether the current issues, particularly that guidance withdrawal and the dramatic EPS decline, truly reflect the full extent of the operational challenges. Have we seen the worst yet? It might look cheap on the surface compared to its highs, but it could potentially get significantly cheaper if the fundamental cost issues, particularly in Medicare Advantage, and those regulatory pressures aren't resolved swiftly and decisively. This could absolutely be a bear trap for those who jump in too soon, mistakenly believing the worst is over without concrete evidence of a sustainable turnaround. The smart money, arguably, will likely wait for clear, tangible signs that these systemic problems are being effectively addressed and that there's a clearer path back to sustainable profitability growth. Buyer beware is the watchword, I'd say.
So there you have it, a truly deep dive into UnitedHealth Group. We've broken down its vast operations, its recent financial performance, the good and the bad, and the crucial factors that will undoubtedly shape its path forward. We've laid out the arguments from both sides, the bull case and the bear case. What stands out to why you, our listener, from all of this information, knowing your specific notes and research that you brought into this? What's your key takeaway?
Indeed. We've certainly explored the significant scale and the strategic vision of UnitedHealth Group. We've contrasted its dominant market position and its impressive revenue growth with the very real and immediate challenges of escalating medical costs, particularly, as we've stressed, in Medicare Advantage. We've also highlighted the lingering impact of regulatory scrutiny, those leadership transitions, and the persistent pressure on the bottom line that has so dramatically impacted the stock price this year. The critical question for you, the learner, really boils down to this. How much of the current downturn is a temporary setback for a fundamentally strong, indispensable company, one capable of a swift and decisive rebound? And how much signals a more entrenched challenge in a complex, rapidly evolving, and heavily scrutinized healthcare landscape, a challenge that might take years to truly overcome? It's a critical distinction to consider for future analysis as you observe their upcoming earnings and beyond. Where you land on that question likely determines your view on the stock.
Thank you for joining us on this deep dive. Before we sign off, please remember that the information shared here is for educational and informational purposes only. It is not financial advice. We are breaking down information, not telling you what to do with your money.
That's absolutely right. Any investment decisions you make or actions you take based on this discussion are your sole responsibility. It is absolutely crucial to conduct your own thorough due diligence and, ideally, consult with a qualified financial advisor before making any financial decisions.
Also, please note that while we strive for accuracy and comprehensiveness in all our deep dives, some of the information discussed here or in any of our analyses may be based on AI-generated sources or analyses. While these AI tools are incredibly thorough and comprehensive, they can sometimes have subtle differences or interpretations compared to other data sets or purely human analysis. So always cross-reference with multiple reliable sources for your own decisions and to get a truly holistic understanding.
Thank you again for joining us on the Deep Dive. We sincerely hope this has equipped you with the knowledge to navigate the complexities of the healthcare market, and specifically UnitedHealth Group, with greater insight and confidence.
Until next time, keep learning, keep questioning, and stay well informed.